Ladies and gentlemen, good day and welcome to Cyient DLM Limited Q3 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Krishna Bodanapu, Non-Executive Chairman, Cyient DLM Limited. Thank you, and over to you, sir.
Thank you very much, and good evening, ladies and gentlemen. I'm Krishna Bodanapu, Non-Executive Chairman of Cyient DLM, and I welcome you all to our Q3 FY26 earnings call. Joining me today on the call are our Managing Director and CEO, Mr. Rajendra Veligapudi, and our CFO, Mr. R.M. Subramaniam, RMS. I would also take this opportunity to welcome RMS to Cyient and also to state that this is his first investor call as the CFO of Cyient DLM. Before we begin, I would like to remind you that certain statements made during this call may be forward-looking in nature and subject to risks and uncertainties. A detailed disclaimer is available in our investor update posted on our website. Let me start with the order book situation. We're pleased to share that the order momentum remains strong and continues to move in the right direction. Our book-to-bill ratio for the quarter is above 1 for the third consecutive quarter. This underscores the sustained demand environment and the effectiveness of our commercial strategy. A significant portion of the new wins this quarter has come from customers we onboarded this past year, clearly an evidence that our investments in customer acquisition are starting to pay off. To support this momentum, we continue to strengthen our sales engine, both in India and across key international markets. We're in the process of adding a number of key strategic sales resources, many of whom have joined, and few of whom will join before the end of the year, completing what we believe is the optimal sales team to continue to grow Cyient DLM. With these additions, the team will be well-positioned and well-equipped to pursue larger opportunities that are emerging in our sector. We're also deepening our engagement with existing customers by participating earlier in their design cycle. What this does is it meaningfully enhances our long-term viability and our strategicness to the customers since we are deeply embedded in their design and manufacturing cycles. Several customers are also showing interest in partnering with us both for redesign and new product launches, and this positions us not only as a manufacturing partner but as a strategic collaborator through the product lifecycle. Coming to revenue, our revenue for the quarter has been soft. This is due to some customer-specific issues that were caused by year-end holiday period and the tariff-related uncertainty. A number of our customers have been in a wait-and-watch mode to ensure or to understand how the tariff situation settles before they start picking up more inventory. These push-outs already are on track to ship in the current quarter, and we do not expect any prolonged impact. This positions us for a stronger performance in the incoming quarter with positive momentum carrying forward into the next financial year. A particularly strong highlight this quarter is the continued strengthening of the margin profile across both revenues and on the order book. The orders that have been booked are forecasted and projected to come at a much better margin than what we've historically delivered. The quality of our order book has also improved significantly with a clear shift towards high-value programs and more efficient execution. This margin is already visible in our double-digit EBITDA margin, which demonstrates the underlying resilience and profitability of our business model. You may see that there is an adjusted margin for this quarter, and this adjusted margin is primarily for two reasons. One is the new labor code, which is a one-time impact, and the second is some M&A impact, which has not materialized, and therefore the cost of which have been spent this quarter. As volumes begin to scale in the coming quarters, we expect operating leverage to further enhance margins, driven by better utilization, improved absorption, and a more optimized cost structure. With a healthier mix of customers, industries, and products now shaping our pipeline, we are increasingly confident that our margin trajectory will remain strong and continue to trend upwards. We are equally encouraged by the traction we're seeing in new high-growth industries, particularly automotive, industrial, and medical. These verticals are central to our long-term strategy, and the progress we are making reinforces our confidence in our diversification strategy and resilience of our business model. In summary, we remain deeply confident about the opportunities ahead. The robust outlook for the ESDM industry, combined with the growing momentum in India and a build-to-spec engagement capability, reaffirms our belief in the long-term potential of this business. We stay committed to driving sustainable growth, investing in innovation, and delivering lasting value to our stakeholders, including our shareholders, employees, and our customers. Thank you for your continued trust and support. And with that, I would like to invite Mr. Rajendra Veligapudi and Mr. R.M. Subramaniam to walk us through the detailed financial and business performance for the quarter. Rajendra.
Thank you, Krishna. Good evening, ladies and gentlemen. It is a pleasure to welcome you all and having an overview of the Q3 results with a business update. As Krishna highlighted, Q3 has been an eventful and constructive quarter for us, both from a business development and operational standpoint. Our sales engine is gaining strong momentum, reflected in deeper customer engagement and a steadily improving pipeline. Importantly, the composition of our pipeline is evolving with a rising of share from various opportunities originating from the India market. We are also seeing a healthy shift in our industry mix, with automotive, industrial, and medical segments contributing more meaningfully. To support this growth trajectory, we continue to build our sales organization, onboarding key resources in Q3 and with a few more additions planned for Q4, as mentioned by Krishna earlier. If you look at our order book and growth outlook, I think the new wins in this quarter combined with strong repeat business resulted in a healthy order intake of 387 crores. This translates into a book-to-bill ratio of 1.3 for the quarter, and we are also seeing a year-over-year growth here, a good growth in the year-over-year. On a YTD basis, our book-to-bill ratio stands at 1.56, which is a strong indicator of robust revenue visibility for the coming quarter. And let me take you through some of the key industry shifts we are seeing in the EMS space and how we have translated those trends into tangible progress during the quarter. If you look at across the industry, electrification and digitalization continue to accelerate in almost every sector, from transportation and industrial systems to energy and consumer devices. This is expanding the scope of electronics content and widening the need for high reliability manufacturing partners. We are also seeing a clear pickup in defense spending across multiple regions. For us, this directly translates into higher opportunity funnels, especially given our heritage and capabilities in high complexity mission critical assemblies. At the same time, geopolitical realignments are reshaping global supply chains. OEMs are actively de-risking footprint, and India is emerging as a credible, scalable alternative. This plays strongly to our strengths and continues to improve the quality and scale of programs we are being invited into. Another important tailwind is the surge in the AI and AI infrastructure build-outs. Data centers, edge devices, and industrial automation programs are all seeing an uptick, and we are positioning ourselves well to participate in these high-growth areas. Finally, within India, government-led investments in defense, rail, infrastructure, and manufacturing continue to expand the domestic opportunity landscape, and we see strong medium-term visibility from these programs. And if you look at on the key business highlights, we were recognized as the best performer in electronic hardware exports by the Software Technology Parks of India for FY 24-25. This is a strong external validation of our quality, delivery, and manufacturing maturity. We also received a risk mitigation award from a key aerospace customer for delivering a highly reliable PCBA program. This is a testimony to validate our proactive efforts to manage threats and encouraging a culture of safety and preparedness. A major focus this year has been broadening our customer portfolio, and I'm happy to share that we added just 2 new logos in this quarter. The first one is in the medical sector, focused on battery management systems for medical applications. The second is in the industrial segment, where we are supporting high-precision electrical motor controls. We had a few more strategic opportunities that were in advanced stages but moved into Q4. We remain confident of converting these in the near term and will share more details in the upcoming quarter. We also commenced the revenue realization from our B2S programs. This is an important milestone, and we see a clear runway for significant scale-up in the coming quarters as the program matures. Specific to this quarter, 4 of our anchor customers are currently involving us in developing their next generation products, 2 from transportation, 1 from industrial, and 1 from defense. We expect revenues from these programs to begin within 2 years, supported by healthy gross margins and higher volumes. These engagements represent a significant long-term opportunity and are expected to meaningfully contribute to our financials from FY28 onwards. In parallel, we have continued to strengthen our B2S team and are identifying specific platforms and technologies to invest in. With this, we can accelerate design-led growth and deepen customer stickiness. Moving to the strategic initiatives, some of the things we just mentioned earlier, but I thought to walk you through some of the things what we are doing here, strengthening to go to market. A major priority this year has been strengthening our sales engine. We are building a stronger sales team across key geographies and reinforcing our cross-functional alignment so that sales, engineering, program management, and operations work as one integrated unit. The focus is very clear: acquire new logos, expand into strategic accounts, and build a robust pipeline of large multi-year programs. This is already showing results, and we expect the benefits to compound over the next few quarters. Building operational excellence. Operational excellence remains central to our value proposition. We continue to strengthen core operational metrics with a deeper push into automation and digitization across our factories. We are investing in advanced manufacturing technologies, including MES, to enhance efficiency and throughput, while also evaluating traceability and also elevating traceability and quality systems. These investments not only improve cost competitiveness but also reinforce the reliability expectations of our aerospace, industrial, and medical customers. Moving to the next one, scaling B2S and platform play. So B2S continues to be a strategic differentiator for us. This year, we are realizing B2S revenue as part of the mainstream business, and our ambition is to scale it meaningfully. We are investing in the right building blocks, people with the right skill sets, enhanced NPI and prototype capabilities, and key technology stacks that will allow us to create a more integrated platform play. This will strengthen customer stickiness and open doors to more design-led programs. Expanding to new markets and building capabilities, I think this is another area where there is a lot of focus today. On market expansion, we are strengthening our presence in Europe, including opportunities for inorganic growth. This is a region where customers are actively looking for reliable partners, and we see a significant headroom here. Defense remains another strategic priority. We are doubling down on global defense opportunities by enhancing our on-ground presence and investing in the certifications required to participate in larger and more complex programs. Finally, we continue to expand our capability stack, whether in cables, sheet metal, or other critical components, so we can offer customers a more complete and integrated manufacturing solution. Together, these initiatives build a stronger, more resilient, and more scalable business. They position us well for growth, both in the near term and long term, while improving our competitiveness and deepening customer relationships. With a strong pipeline and continued traction in the India market, we expect momentum to remain robust in Q4, setting the foundation for a strong FY27. This gives us confidence for a solid growth path next year. Another highlight is the positive shift in business mix. Our margin profile has improved significantly in FY26 till date and is now structurally healthier. We reported strong gross margins in H1, and this trend continued into Q3 as well. The new orders we are booking also carry healthy margins, reinforcing our path toward sustained double-digit profitability. As the revenue growth resumes, we expect improved absorption to drive further margin expansion. So in summary, before I conclude, I would like to summarize some of the key takeaways. One is our order backlog remains strong, supported by book-to-bill ratio of greater than 1.5 on YTD basis. Build-to-spec and NPA engagements with key customers provide robust long-term visibility. Third, we are well positioned for growth in FY27. Fourth, healthy double-digit margins with further upside expected from operating leverage. So with that, I will now hand over to RMS for the financial update. Thank you all for your continued support.
Thank you, Rajendra.